market, and today is Friday. Excuse me, let me see that. September 4th. Had a late night last night. Got back about 2 o'clock in the morning after watching Western Illinois play Eastern Illinois. My son Joey had about 7 catches. A little concerned though. He banged up his hand a little bit, but he's going to be okay for our game against Illinois last week. We beat him 33-5. So very excited about the college football season starting off. All right, so I'm going to talk about the markets and talk about what's going on, and I'll start sharing my screen in a second. But remember what I've been telling you for the last couple weeks now since we put that low in at 1831. Let me pull this chart up again. I just think the most important thing you have to look at is the fact that we've got this trading range that we're going to be stuck in. We're not stuck in it. I think the increased volatility, please stay around. This increased volatility gives us all an opportunity to make money when we're not right all the time, right? So I think that you know, like I said before, I look at this as like when they put Monday night football in, right? Got to get even. So when you have 4,000 point ranges, you can be wrong a couple times during the day, but when you get your winner, then you can jump on it. So yesterday I talked about how I thought the market would go up and test a higher part of the rally of the range, but I still think it's a two-sided trade. And what do? They break 2,000 points on the close, and we're down 4,000 points from yesterday's high. All right, unemployment report came out today. And, everybody keeps speculating on the Fed. And the really thing that bothers me about the way the markets trade now is that the government used to respond to scandals. Like like I said, I've been trading a long time. It started in 1982, and I saw the scandals that have gone throughout the years. I mean, when I first started trading, interest rates were 18% to up to 21% as a result of what was going on in the savings and loan industry. We had rapid inflation and so on. So think about the environment. I've seen the market go from 18%, 21% down to 0%. So somewhere down the road, maybe I won't still be alive. I think it'll eventually trade back to the medium, the median range. Right now we're been at the low end of the extreme. And was my point that I was trying to make is that governments always respond to scandals, right? Look at what we got now with Dodd-Frank, right? Because of what happened in 2008, right? So what the government knows is that you can't always leave it up to the economic community to do the best things, right? I saw 2000, we saw the bubble. We saw the market break in 2008 with the real estate crisis. I've seen the Ivan Bolsky scandals, and they had to redo Wall Street and the way they monitor insider trading. I've seen the currency devaluations. I've seen the fall of communism. I've seen all the different things. And the one thing that tells me is that when all these markets are everybody's thinking the same way, you get herd mentality, which will cause big swings. And for people like us, look, we don't have enough dough to do what the big guys do, but we do have enough dough and enough know-how to stay in front of the curve. We've got to stay in front of the curve and take advantage of when they're throwing the market out of equilibrium, because they don't have the ability and flexibility to move slowly and with undetected, right? They're moving billions and billions and hundreds of billions of dollars around. So that's the goal of Man Over the Market, to teach you to understand what's going on. How do we recognize price movement, right? Look, if we were all great economists, we could sit down and say, okay, the market, take our little slide rules out and say, well, I think the market's going to do this, and that. Well, you know what? Here's the problem. I've never seen a trading program that hasn't been successful if you had enough time or money, right? So at the end of the day, we don't do that. What we want to do is recognize price movement, take advantage of it, let you not only price, we like to recognize volume and allow you to, in an intraday with these volatilities, make some money. And, if you're a good trader, you can make a great living and you just got to understand, you got to follow rules and become very disciplined. All right, so that's my lecture for this morning. Let's talk about, you know, how we look at the market, and I'm going to start sharing some screens right now. Over my left shoulder, there was the old days, baby, right here. This is when people feared me. Nah, not feared me, but they listened to what I said, and they watched me, that's for sure. All right. So here's the chart that I've been talking about, right? So here we are. I've talked about how I thought the market is going to trade in a range from, you know, this is basically 73 half, and I think it's going to trade down to here somewhere back. I think we're going to go back and test that 1831 level that we made on the spike low. Remember, it was the spike low of the day. I don't remember the date exactly, Anthony, but it was the date that I should find it right here. Here we go. I'll put it right here. So this was the day that we reached. It would have been the circuit breaker, right? So we made that low of 31 on what is that? That is 8/24. So August 24th, we made this spike low. All right, and I've said this. This is a result of when we made these lows back here in March, and we just spiked right up. Look, we got one just straight up. There's no volume. These were low rallies, and I remember thinking to myself, like, you know, markets are not supposed to trade that way. Here is the way they're supposed to trade: up, down, up, down, up, down. Build the base, build the base. Eventually, somebody's going to give up. It's either going to be the buyers or the sellers. Meanwhile, while we're inside of this range, there's a tremendous opportunity to make money during the movement of when the institutionals are trying to lay down the long-term bets. So this is what we do, right? I don't mean to call it bets, but you know what? You got to call it what it is, right? You got to call it what it is. So let's take a look at the profile now. For people that don't understand profile, this is just a different way to look at the market. And these, this is started by Stottlemyre, where he looks at the market on price movement according to brackets. Starting, every bracket is a 30-minute period. I've got 30-minute periods here, okay? So when I traded on the floor, we had trading cards. And on the trading card, we would put down the price, the opposite broker, who he cleared for, whether it was a buy, whether it was a sell, and then we would put the trading bracket. And then that got key punched into the computer system at the Merc. And when they got a key punched in the computer system, that knew what time those trades occurred. Well, now with electronic trading and the E-mini, you can just put your into the computer, and the computer can keep track of all this information. And so not only, so back in the let me think about this, maybe 2000, 2002, they started associating volume with price. So this is all this little stuff that we see here on the right-hand margin. So we're seeing how much volume was traded at that price. So what we've noticed over the years that you have high volume, see the high volume up here, okay? And then you have low volume like what you see down in here, right? And then you're gonna see real low volume down in here, 1830, right? See, no volume's been done here. So I think the market needs to go back down there and test it, because if you're going to get a rally, okay, you're going to get a concentration of volume above or below the areas the market's going to move from. And during that time, people are making up their mind. Institutional people are making up their mind, and they throw the market out of equilibrium. That's what our job is. When it's thrown out of equilibrium, then we're supposed to take advantage of that, those price discrepancies. Okay. All right. So yesterday, I had talked about, you see this little tail that they made, right before the opening, and then right before the opening, if you look at bracket B, we were right in here. And I had said yesterday, I thought that the market would have to go back up there and test this area again, right? And here we go. We top out at 73. And by the end of the day, so here's bracket N, which is the last 15 minutes of the day, we're back down to 1945. We've got a 3,000 point break from 73 to 45, okay? So give or take a few points, right? So now, overnight action, all right? So we haven't even taken out we started here and we've moved down ever since. Okay, so a couple things I'm looking at. So they came back now on the, we had this spike down. They rallied up on the unemployment number, and now we're trading right about here, right? So I'm thinking that the market still needs to go down and test this area. Take a look at this. These are what we call single prints. So I'm thinking, see how there's a little volume down there. I think the market's going to move back towards the 1900 area, 1906. Okay. Now it's Friday. A lot of action's gone on. So, Fridays tend to be a very choppy day. Okay. People flatten out. And after the first hour and a half, you got to take a look at where the market is, because it could just, peter out from there. Just peter out. So let's look at what I'm looking at for the day right now. I'm talking about our value area high, low, and so on. So because we're trading way below those areas. All right. So we got a value area high from yesterday of 1963.30, 1951, and then 1940. 1951 is the mode or point of control. So now this is just another way that what I just showed you on our profile, we gray it out. So we have a point of reference for the day looking at our charts. This is a 15-minute chart. Okay, and then we have a bull bear zone here of 1946 half right here, 1946 half, and the bottom of value is 1945.75. We got the 5-minute pivot. I'm sorry, the 15-minute pivot at 1941.72. Okay, we got our CCI below. Okay, and we are in a sell as far as the 15-minute pivot is concerned. Okay. So we would need the market to come up and take out this 41.75 for it to start getting bullish again. All right. So we got a 5-minute pivot sitting up here at 1930. Let me open this chart for you. Okay. This is called the Hashimoto. Okay. I like to use it because it kind of gives me a point of reference of, and these are equal vowels, so it's showing volume associated with, they get fatter when there's more volume, wider. It's a nice picture, but I don't think it's as accurate as we like it to be. All right, so when I look at this, and this is just telling me, above and below this in here, the market's still making up its mind, meaning inside the maroon area. Okay. And if we're below it, I like to stay with the trend, which to me is moving down. It's in, it's in the short mode, and this is why we color our stuff up, right? Even our CCI to match this. So at Man Over Market, what we're creating for you is great visual tools that you'll be able to say, okay, well, I got a CCI that's red. I'm trading below. So you got a bunch of green stuff going up here, right? You're going to get these algos and these big whips when it comes to markets, right? Because people all have different time frames when they enter the market, and they have different pain level for fear and greed. So people get overly short. You can see. Now, one of the things that was a brainchild of Pat Tabbitt is what we call the VWAP, right? We got he didn't create VWAP, but it's the value weighted average price, and he's now put in these extension lines. So this green line, okay, all right, and this red line are usually 2 standard deviations away from the VWAP, as you can see it moving down. The VWAP is the value weighted average price, and this red line we have going through here shows us that it's moving down. Well, we got back down in these exhaustion areas, and you got to be careful because you're in an oversold state. So when we get this stuff rolled out to you, trust me, you guys are going to love it, and it's going to be delivered in a very simple manner, and that's our goal, right? So right now I'm taking a look at, let me put the scissors up, and I'll put them here so that you guys can see that I monitor these also. And I know that we're on a time delay, so I'm going to slow it down a little bit so you guys understand what's going on. All right. So here we got the Russell. All right. You can see it's trading below the 5-minute pivot. It's got to take out 1136 half. 1136 half to get bullish. Here we got the Nasdaq. It's got to get above 4201.75 to get bullish. 620, and then in the Dow it's 16,226. Now, remember, because we've come back from where we're, down from where we're at, we have 15-minute pivots that are up there also, and I will get those out once we take them out. But if we take the 5-minute pivot out, and we haven't taken out major resistance on the top side, the 5-minute pivot tends to be a little more volatile, especially with these times of high volatility. So what will happen, it will revert, okay? And what happens is if it revert, once we take out the pivot, for the short term, we're in a buy, but if we don't take out major resistance on the upside, it will revert down to a low, and they end up becoming our targets. Something else that we're gonna have to explain to you as we move forward with Man Over Market and you guys get into our programs, okay? So those are coming. They're coming. Trust me, they're coming. All right. So based on what I'm seeing here, I am looking. Gotta move this stuff here for you. Okay. I am looking at a two-sided trade. Very, very two-sided trade today. If we can't take out a 5-minute pivot, I mean, this is basically 1,000 points. Can it get back in, even move back inside value today? I mean, the reason we track value is that they tend to be the magnets and so on. So you got to take a look at it. Let's look at here's this is a day only, okay? A day only profile. And if you look at the 20-day average, way up here is the median or the mode of 2080 and quarter, and we're trading at 1936, basically 94. Okay, so now we're backing down in here. So I think the market. So here's 1898. There's 1916. So we're trading here. Do we go back and put in more volume down in here to build this base that I'm talking about? On a long-term goal to trade, I think the market will rally by the end of the year. I don't think the Fed is going to raise rates. I think the Fed is going to hold steadfast, and it's got too many factors going on around the world for them to scare the rest of the world, right? And that being China. China is in its infancy, much like the United States was years ago. With its economic policies. That's why you see so many different things that they are experimenting with the devaluation of their currencies and so on. So let's look at some other factors that I think that are important. So let's look at gold. So I've said this a million times. That gold is a demand product, and here we spiked up on the number, and now we're way back. Trading down to 1,115. People are telling me this is going to under 1,000. Okay, and that can only mean, remember, I don't believe gold's a function of supply, but I do understand that gold is a commodity that people use to hedge against inflation and fear, right? And when you buy gold, you don't earn any interest on it. So when your money is tied up in it, you're sitting there with it, and if it goes down, you're losing the valuation of the gold, but also you have to pay to store it, right? So I just, with commodity prices where they're at, that it's just not in a demand product right now. Nobody wants to own it. So I can see it moving under 1,000, but I'm going to tell you right now, it's down $6. It was up $1 after the unemployment number. So I just think gold, you gotta get on the trend with gold, and right now the trend is, these big target areas. So I think under 1,000 is doable. So that means we're going to trade gold from the short side as long as the market keeps moving down, right? So we got to take a look at gold now. in that manner. Let me take a look at the bonds, move them over. So the bonds are here, trading way above value at 155. Now, when I throw these numbers out because I don't, I'm just giving you something to think about, right? So when I take a look at bonds, I'm looking at the fact that the bonds are trading way above value. But I look at where we're at 155, the 30-year. This is the 30-year bond. From the low of 148 something, 140. Don't quote me. I think the low was down there in the 147, around that area, right? And we got the highs up there of 165. So the bonds are kind of just sitting here waiting to see what the Fed's going to do, right? And when the Fed makes up its mind, we're going to, then speculators will have to adjust their positions. But here's the deal, right? The dollar's already strong. The rest of the world with China and everything else is in, let's say, fragile state, right? And people raise the rate on bonds when they want to attract buyers. We don't have to attract any buyers to our bonds right now. People are buying our bonds because we're considered the strongest economy in the world. Okay, so we got to understand we're the strongest. And I said this a couple of times. We are the cleanest shirt in the dirty laundry right now. So that's the way I look at bonds. So you got to kind of stay on the sideline with bonds until the Fed makes up its mind. And then let's talk about oil. Okay, so oil has been on a rally. We're trading up above. Trading inside value. I got a bull bear zone here at 46.35. We have a nice break off the low. We have a nice rally off, like a $10 rally so far. And a little bit $7 or $8 rally. So listen, here's the deal with oil. Okay, there is oversupply and there's overproduction. Okay, and this is not about oversupply and global slowdown right now. What it's about is how much pain can OPEC, all right, put on the rest of the suppliers of the world, the U.S. suppliers, and leave the prices where they can slow down production. You got to remember, the OPEC gets their average price. They're getting this oil out of the ground at $15. Their biggest cost is what they do for their socialized programs that they have for their populace. So, the best thing for them. And we would all do this if we had this control, right? We overproduce, we throw it down. The average price of shale in the United States is what? I'm hearing $50 to $60 break even. All right, that's to get it out of the ground. What about transportation? Now you got to transport it. So, there was this big call by the U.S. government to be less dependent. Okay, now they've spent billions and billions of dollars producing, and now what did OPEC do? They forced us down in pain. And that's not, we don't even know. Just think about what they're doing to Russia and look at all the things that's going on in Russia. So I think that oil will be a buy eventually, but they got to inflict some more pain on, they're going to be Dr. Pain on the rest of the world when it comes to oil. All right. So today, two-sided trade. I'm on the bear side. I think that the market I think the market could trade back up into here, the 1930, 1927 area, okay? When I look at the profile from a longer point of view right here, I think that this is unfinished right here, okay, at 1907, and I think these single prints at 1898 are unfinished, okay? And when I look, so let's take a look at it from there and then stay updated with us throughout the day. I know this has sort of been a long interview, but as long as it's live, you can go back and look at it. And remember, Anthony, we got any questions quickly? I know we got 5 minutes.
5 minutes till the open, so.
Okay.
Everybody's pretty content.
All right. So I know a lot of rhetoric this morning, but I want you to hold on, let me stop sharing here so I can so you guys can see my handsome face. Okay. I'm 84 years old. I look good for my age. I just want you to know. Look there. That's me over there. See that? In the pits years ago. Right here. That's the book I wrote. I wrote 2 books. I wrote 2 books. That's 2 more than I ever read in my life. And then this is me in Trader Magazine. I was You know, when that was around, I was in their Hall of Fame, but they're not around. So I guess it doesn't even mean anything anymore, right? All right. You everybody have a nice Labor Day weekend and enjoy yourself. Remember that I think you're going to get some volatility this morning and maybe the end of it, you know, because people are flattening out for the weekend. And then we'll, you know, and remember China's been closed for the last couple of days. So I think that, you know, sometimes it's make some dough, go home, all right, and spend the weekend with your family. It's going to be a hot one here in Chicago in the 90s, mid-90s all weekend. College football kicks off, so we got a lot of stuff to do when it comes to watching things, and that even goes for our female traders because I know they love football, right? All right, Anthony, got anything to say?
I'm good.
Come on over here, show everybody your pretty face. Come over here, come on. My nephew, we're moving our offices again, and here he is. Look at that. Look at that guy. Look at that. Huh? He's almost as handsome as I was, but he's my brother's son, and I was better looking than my brother, so it doesn't matter, right? It's just the way it is. So, all right, everybody have a good time. Good luck trading, and stay with us. I'll talk to you later. All right? Bye.